Don't forget, we're still right in the heart of earnings season, not just talking about coronavirus. And over the past couple of weeks, we've seen the acceleration of some major long-term trends that we need to talk about. Take cord cutting. People have been bailing on their cable subscriptions for years, but these subscriber losses have suddenly gotten even steeper. Jeez, my channel just knows that Viacom. Have you seen that thing? It's been one of my worst investments ever. Cord cut. Consumers have too many other options now that have so many streaming services to choose from. So far this season, we've heard both from Comcast, the parent company of this network, and AT&T. Their results tell me that the future belongs to the cord cutters. For example, Comcast reported a fantastic quarter, but there was one ugly line item, the decline in residential video customers, meaning cable TV subscribers down 133,000 year over year. Now, the thing about cord cutting is that it's not really that bad for the cable companies. They more than make up for it with their fast-growing broadband business, because you can't really substitute Netflix or Disney Plus for cable without high-speed internet. Comcast broadband division was up 9.4% last year. Wow. And they even have their own streaming service coming out soon, Peacock. As for AT&T, the video numbers were even uglier. They lost 945,000 premium video subscribers. Even the lower-cost skinny bundle that was supposed to compete with streaming services lost 219,000 net subscribers. Again, though, that's not the end of the world for AT&T, because now they have Time Warner, and they've got some major streaming services, including HBO Go. While AT&T claims that these losses peaked last year, Comcast says it will only get worse in 2020, and I'm inclined to believe them. So how do we play it? What's the best way to actually benefit from cord cutting? Because you know there's always a way to make money on these big secular trends. For the past 2.5 years, Roku's been the big winner because they're one of the few pure plays on streaming. Roku started out as a hardware play. They make a little box that lets you stream programming from any service straight to your television. But gradually, they switched to software, creating a platform that's now built into most smart TVs. Roku makes money by taking a cut of the revenue that these streaming services make using their technology. It's a subscription service. They get a piece of the subscription. If it's a pay-per-view service, they get a piece of its rental fee. If it's an advertising-based service, they get a piece of the ad money. Holy cow. This model's been very successful for Roku. It's why they were able to grow at an astounding pace. And it's why the stock has been an incredible long-term performer. However, in the past few months, well, you know what's happened? Roku's stock has become a dog. Recent weakness started in November when the company reported its most recent results. The problem? Roku sales grew at a 50.5% clip. Now, I know that's the kind of numbers most CEOs would kill for, but it was down from 59% the previous quarter. In short, people started worrying that the growth had peaked. More than that, Roku's stock had been on an epic tear last year. At the beginning of 2019, this was a $45 stock. By late November, it was a $160 stock. I think that it deserved most of that run, though. But by the winter, Roku had clearly gotten ahead of itself. That's why it got slammed in early December on a relatively benign valuation downgrade from Morgan Stanley. After such a huge move, though, they didn't like the risk-reward anymore. In response, the stock lost 15% of its value in a single session, which kind of proved Morgan Stanley's point, didn't it? By mid-December, we learned that the CFO was leaving. I don't think there's anything particularly ominous about this departure, but it's definitely a negative, especially when you're dealing with a high-flying growth stock. Worst of all, last week, Roku had a major dispute with Fox over the distribution agreement it has, which was set to expire on Friday. No Fox, no Super Bowl. Roku and Fox reached a deal, and there was no blackout. But we're seeing more and more of these disputes between streaming video distributors and content providers. They don't want to give Roku a cut because with a little setup, you can stream their services from your computer or your phone directly to your TV. That's what I do. No Roku needed. Or you buy a cheap little dongle from Amazon or Google to do the same thing. Now, I don't want to count Roku out, especially as its stock just jumped 6 points today. Company reports in a week and a half, and if the numbers are strong, I expect the stock to soar. However, even with the stock down nearly 50 points from its highs last fall, I'm not loving the risk-reward here. Full disclosure, I have a terrible record with this Roku. So if you don't take me serious, I do not blame you one bit, but I do say you can't get them all right. That said, I think I have a more enticing cord-cutting play. I've introduced them to you, but I want to reiterate it. It's called the Trade Desk. This is a software company that helps its clients manage data-driven digital advertising campaigns. Basically, their platforms help advertisers get the most bang for the buck. For years, that made me a little nervous because anytime someone's making a killing in ad tech, well, you always got to worry that may be wrecked by Google's algorithms or Apple's ad blocking technology. The Trade Desk has been navigating these obstacles for years, but it's a game of cat and mouse and it never stops because the big boys don't want to share their ad revenue. When we last spoke to CEO Jeff Green last December, he put a new spin on the story. The Trade Desk is now a cord-cutting play, plain and simple. They build out their technology to help customers find the best places to advertise within the streaming world. Just listen to what Green has to say.
We go to the biggest advertisers in the world and we say, you need to figure out which digital ads to buy. Sometimes it's audio, sometimes it's TV, sometimes it's display ads. It could be on your phone, it could be anything. But we're trying to help them objectively decide what to buy. And because we don't own any media, all the biggest media companies in the world are partnering with us first to ask them to help bring advertising demand.
In other words, maybe the Trade Desk is the Switzerland of streaming, the neutral third party that can work with everybody. I used to call Roku Switzerland, but they've gotten too big for that. With 30 million users of its own, Roku has a lot of heft, a lot of influence. That's generally a good thing, but it also means they're increasingly more likely to be seen as a competitor than a partner. Look at last week's conflict with Fox. The Trade Desk, on the other hand, is still a pure facilitator. They can work with anybody. That's what we want. One more thing. The Trade Desk also reports later this month. We don't know exactly when, but it will probably be around February 19th. I want you to pay close attention to this one. If we get another big sell-off between now and then, I'm giving you my blessing right now to buy it. Yes, it's that good. Bottom line, Roku and the Trade Desk are both high-flying momentum stocks that benefit enormously from cord cutting. But because Roku's more consumer-facing, people reflexively buy this one as the true cord-cutting play. And at this point, I'd much prefer the less well-known Trade Desk, which has been better financials, and I think is a better story. Let's take calls. Let's go to Cam in Massachusetts. Cam.
Booyah, Jim.
Booyah, Cam.
My question is about Snapchat, ticker symbol SNAP. Basically wondering if the stock could be considered a buy at these current levels. I know that they report earnings tomorrow, so if the stock surprises to the upside, could it still be considered a buy?
Well, at this point,
if the stock disappoints?
At this point, we're too close to the earnings. I will say, though, I am positively inclined towards Snap because I think that, I buy some before and then maybe some after. Why? Because I think Snap is rapidly developing into being a great alternative for a lot of advertisers. Let's go to Bob in New York, please. Bob.
Hey, Jim. How are you doing?
All right. How are you?
Jim, I'm fine, thank you. Jim, at this point in time where the coronavirus seems to be dominating and driving the markets, a company like DocuSign, which virtually eliminates human interaction, it seems like an equity that demands attention. Do you agree?
I think it demands attention because it's so fabulous. I mean, the stock was bid up today, and it's at its all-time high. But you know what? This is the way of the future, obviously. It's just too ridiculous to do it the old-fashioned way. I bless DocuSign right here, with or without the coronavirus. Let's go to Dylan in Florida, please. Dylan.
Jim Cramer, booyah, booyah, booyah. Glad to be on your show.
Well, what's up? What's up, my friend?
What's up, man? I was just wondering, what do you think about Uber? I know they got a lot going on. They're partnering with Hyundai for aerial taxis in the future. They got a merger going on with DoorDash. They're trying to get into the autonomous car movement. Where do you see their future? Are they a buy right now? I know they're kind of on the rise back from their sale of an IPO. How do they look?
Look, Uber, I think, is a great investment up to 45. I think that they are getting a lot of their house in order. All they have to do is close a couple of Uber Eats or sell Uber Eats to another company in that business. And I think the stock tacks on maybe 6-7 points. All right, cord cutting is a major long-term trend. The best way to play it, well, is Roku, except for now, I'm thinking maybe even Trade Desk better. Much more Mad Money ahead, including my exclusive with Zoom Video. Company is soaring today. What's behind the move? I'm talking with the CEO. Then, coronavirus fears escalated over the weekend with news that 30% of adults don't have a primary doctor. How is Doctor on Demand preparing for the unknown? I've got the CEO. And all your calls rapid fire in tonight's edition of the Lightning Round. So stay with Cramer.
Don't miss a second of Mad Money. Follow @Jim Cramer on Twitter. Have a question? Tweet Cramer. #MadTweets. Send Jim an email to madmoney@cnbc.com or give us a call at 1-800-743-CNBC. Miss something? Head to madmoney.cnbc.com.